All right, today we are diving headfirst into the world of high-stakes finance to look at what happens when a massive, unstoppable economic force, I'm talking inflation, collides with a financial powerhouse like private equity. This is going to be interesting.
So, that really brings us to the big question, right? For years, private equity has just seemed invincible. But now, rising inflation is throwing a whole new set of challenges its way. Is this the one thing that can actually weaken this financial giant? Is it their kryptonite?
To really get this, you got to picture inflation acting like a giant vice. It's putting pressure on the classic private equity model from pretty much every direction, forcing them to fight a battle on multiple fronts, all at the same time.
But the single biggest threat isn't just that, things get more expensive. No, inflation strikes right at the very heart of the entire private equity model. And that heart, it's one word: leverage.
So, what exactly is leverage? Well, in the simplest terms, it's like taking out a gigantic loan to buy a company. And look, when interest rates are low, this is an absolutely fantastic strategy. You can buy huge assets with just a little bit of your own cash. But when inflation kicks in and interest rates start to climb, that brilliant move suddenly gets really, really risky.
And that brings us to the very first squeeze, the cost of debt itself. As soon as central banks raise interest rates to fight inflation, all that money the private equity firms borrowed suddenly costs way more to pay back. And that means more of a company's cash has to go to just paying off its loans, leaving a lot less for, growing the business, innovating, or hiring new people.
And at the exact same time, there's a second squeeze happening inside the company. Inflation drives up the price of literally everything it needs to run. We're talking raw materials, energy, even salaries. If that company can't pass those higher costs on to its customers, well, its profit margins just get squeezed thinner and thinner.
So all this pressure builds up to the third and final squeeze. And this one hits the exit strategy. The whole point of private equity is to buy a company, make it better, and then sell it for a huge profit, right? But in a high inflation world, the economy gets shaky, buyers get cautious, and those sky-high valuations that PE firms are banking on, they can just vanish into thin air, making it so much harder to sell and get those big returns for their investors.
But hold on. Private equity firms are not just sitting around letting this happen. They are built for tough times, and they have a whole strategic playbook designed to fight back. So how do they actually counter this three-way squeeze?
Well, the smart funds use a kind of three-pronged defense. They go after companies with what's called pricing power, they drive relentless operational excellence, and they are super careful about which industries they even get into in the first place. Let's break each one down.
Okay, strategy number one is all about pricing power. This just means they invest in companies that are so essential or so dominant in their market that they can raise their prices to cover their own rising costs, and guess what? Customers will still buy from them. Think about a company that makes a must-have piece of software or a unique medical device. They're way more protected from the shocks of inflation.
And that leads right into the second strategy, operational excellence. You can really see the difference in approach here. A normal company might just react when its costs go up, but a PE-backed company, they proactively hunt for ways to be more efficient. They bring in experts to streamline everything, cut waste, and optimize every single part of the business. That makes them way more resilient than their competitors.
The third strategy might just be the most important one of all, because it happens before a single dollar is ever spent. It's all about choosing where to compete, picking the right battlefield from the very start.
And what that means is focusing on what are called defensive sectors. These are industries where demand stays pretty consistent no matter what the rest of the economy is doing. Think about it. People will always need food, they'll always need healthcare, and they'll always need basic infrastructure like power and water. By investing here, PE firms are basically betting on stability in a very unstable world. Okay, so we've looked at the squeeze, we've looked at the playbook. What's the big takeaway here? Well, the story of inflation and private equity isn't some simple good versus evil thing. It's a lot more complicated than that.
Here's the crucial point. Inflation isn't an automatic knockout punch for private equity. What it is a really tough test. It separates the truly skilled, strategic operators from the ones who just got by on cheap debt. The firms that can actually execute this playbook, the ones that find companies with pricing power and make them incredibly efficient, they can not only survive, they can actually come out on top.
And that leaves us with one last big idea to chew on. For decades, private equity felt like a game that was all about who had the most money. But in this new world of high inflation and expensive debt, has the game fundamentally changed?
Has the actual skill, the ability to run a business better, become more valuable than the money itself? It's a question that's going to define the next chapter for this entire industry.